So are you ready? Are you ready to start building your wealth and securing your financial future? Well, following the same old advice will get you the same old results. So by the end of this video, what I'm hoping to do is give you a clear path. And I want to make you clear on the key places your money needs to go in order for it to grow. So again, stop doing the same thing and expecting different results. Let's change one thing, and that's where your money goes first, and the rest will just fall into place. Let's get into this. So one of the biggest things we need to start with is debts. Just like on the board, you all have debts of some sort. Some of you have credit cards, right? So we got some credit card debt, we got car loans. How many of you have one of those cell phone loans? You know, you went in and you wanted that new iPhone 14. They said, oh, no problem, we'll finance that. Yep, you probably got one of those. Maybe you got some equipment loans. I don't know, maybe it's that Peloton or whatever it is. And I don't know, other lines of credit. And I'm just going to put a remodel loan. So does this sound familiar to any of you? Well, every single one of these debts carries two things. Number one, an interest rate that you're paying someone else's bank, and a monthly payment. So let's just put some numbers. Let's just say the equipment loans, I don't know, let's do 5%. The remodel loan is 7% and $200 a month. I'm just going to throw numbers up here. Your cell phone, we'll do $60, and let's just say it's 0%. Your car loan, let's do that at 5%, and let's call it $500 a month. And the credit cards, let's combine them all and say it's $200 a month and an average of 20% interest. See, these are all loans and all debts that require you to pay a monthly payment and interest to somebody else. Okay? So this is all leakage. Think of a boat. All of these debts are resulting in holes in your financial plan, because every one of them steals money from you every single month. So here's the solution. If we want to build wealth, why don't we start here? Like, think about this. Like, let's just talk returns. Everybody wants to invest to make big returns. What are the returns? How about 5%? We can make 5% just by paying the equipment loan off. We can make 7% by paying the remodeling loan off. Cell phone, well, that's 0%, but we'll get there. Car loan, we can make 5%. And the credit cards, we can make 20% just by paying them off. So how would you go about doing this? It's simple. It all starts on the other side. So the first thing we need to do is we want to think like the bank. We want to create our own banking system. But the first thing we need to create a banking system is we need income that you're saving. This is the first law of wealth. I always suggest no less than 10%. So out of your income, you need to keep 10%. But the next question is where does that savings, that 10% that you're saving, if it's more, great. But if it's less, well, we need to up it. We need to get to 10%. Where does that money go? My guess is this 10% is going into a bank account, right? Maybe it's going into a 401k, maybe an IRA. Am I getting close on some of these, folks? My guess is this is where your savings is going. And all of these places do one thing. They take control of your money away. The bank, you're out of control of your money. That money's not in your control, it's in the bank's control. They're making that money go to work for them, like all my other videos show. 401k, yeah, 59.5 is the magic number there. So you don't control that money until 59.5 or after. And if you take that money out sooner, it's a 10% IRS penalty, plus you got to pay tax on it all, if it's not a Roth. IRAs, same difference. So why don't we just do this? The money that you save, what if all we wanted to do is we wanted a risk-free return? Okay, great. Simple. Let's pay the debts off. That's a risk-free return. And instead of saving all this money and all those investments, let's just change where that money goes first. And let's put that money in what we're going to call your own banking system. BYOB, be your own bank. We have to think like a bank, but we also have to change where the money goes first. So what is this thing over here? Well, this is a specially designed and engineered whole life insurance policy. Now, as soon as I say that, what do you think? Oh, that's a overpriced life insurance policy. That just pays high commissions to the agents writing it. That's garbage. Dave Ramsey says that's the worst place you can put your money. But hold on. When I said that, what did you hear? You heard one thing. You heard whole life. You didn't hear specially designed and engineered, did you? You see, why would I ever tell you to put your money into a regular whole life that your broke-ass brother-in-law sold you, that you have no liquidity, no access of that money, and it's an overpriced, over-commissioned product? You see, I took one from the wealthiest families and also from the banks, and I learned how to create specially designed and engineered whole lives, and I did it just the same way that the banks create them and the same way the wealthy have. And we reverse engineered them. We just mimicked what they do. And what we can do is we can design and engineer a whole life to function a lot like a bank account, where you're going to have access to the money immediately in the first 30 days. Maybe not all of the money, but anywhere between 60 and up to as much as 90% if you did a dump in. Okay? But I'm going to put a little asterisk because a lot of people only hear the 90%. It's going to be between 60 and 90, somewhere in that range. And that's only in the first year. And how we do this, how we build the plan so that they give you immediate, in the first 30 days, access to your money, is we create them by reducing the amount of death benefit. That's right, we put the lowest death benefit on that we can under IRS rules, which is called the MEC 7 pay rule. You can look it up, MEC 7 pay. And what the MEC 7 pay does is it says we need X amount of death benefit to support X amount of money. So let's just use somebody that's making $100,000. So we're going to save 10%, which is $10,000. So we want to put $10,000 into this policy. Well, the first thing we're going to do is going to put a death benefit on this whole life that meets what the IRS needs this policy to have so that it's still considered life insurance. And what that does is by reducing the death benefit and by putting the majority of the money, anywhere between 60 to 90%. Okay, now you're seeing the math. 60 to 90% of this $10,000 is going to go to a rider that is commonly called paid up additions, which does not buy just death benefit. The paid up additions rider gives you liquidity of the money. So we're going to put that 60 to 90% there. Now, here's the fun thing. What this does is reduces our commission anywhere between 60 to as much as 90%. So we're making 60 to 90% less so that you have 60 to 90% more. So now that we understand how this works, let's just do the math. Let's just use 80%. We'll go right in the middle, okay? You put 10,000 in. We have 80% to use right away. So you have 8,000 bucks. So I'm just going to put a number here, $8,000. But over here, we've got all these debts. Now let's just say the equipment loan is $2,000. This one's $3,000. We're going to say the car loan is $10,000 left on it. And then down here, your credit cards, we'll put $10,000 on those too. But there's a bunch of different credit cards. So now what we want to do is we want to earn a risk-free return by paying off these debts. Here's the game. We're going to take a loan from the policy because by taking a loan, it doesn't affect the money that you put in. Your money that's in there is earning anywhere between 5 to 6% gross with dividends. That's right. Your money's earning 5 to 6%. That's way better than what the bank's paying you, right? So when we take the $8,000 out, what we're going to do is we're going to deposit that in a segregated bank account, and then we're going to redeploy that money out. Now looking over here at all these debts, what I want to do is I want to see how far can this $8,000 go. Now this isn't always the way we do it, but I'm just going to keep this simple. We got $8,000. So the first thing, let's just say we pay off the equipment loan. There goes 2, okay? Then we pay off the remodel loan. There goes 3. And then we pay off, I don't know, actually let's say the cell phone's $1,000. I'm just going down the line. Let's pay off the cell phone. So that's 5, 6,000. And then let's pay off some of these credit cards. So we're going to pay off $4,000 worth of these credit cards. So now we owe $6,000 in credit cards. And what that's going to do now is we paid all these debts off. So now let's just add this up. We got rid of this loan, which was $2,000. We got rid of this remodel loan, which was $3,000. We got rid of the cell phone loan, and we paid down some of the credit cards. So that frees up $100, $200, $60. So let's add these up. So now we have $100 freed up from the equipment loan, $200 freed up from the remodel loan, $60 freed up from the cell phone loan, and let's just split the middle and say we got $100 freed up from the credit cards we paid off. So what we're now going to do is we're not going to be done paying those because this is your bank. We took a loan from your bank to pay off their bank loans. But because we did that, we want to treat our money the same way you treat the bank's money. So we want to take all these payments and we want to put them back into your bank. And we want to repay the loan we took from your bank. So how much is that? Well, 1, that's 3, that's 460. $460 every single month going back over here. That means every year we got $55.20 going back into your account. Now this is not new money. You didn't have to work any harder for this 5520. It's money you were giving away. It's money you were paying off to all these different debts. That's a risk-free return. Let's go one more year. The second year, you put another $10,000 in. Now remember, the original $10,000 you put in, you're still earning interest and dividends on that. Because the $8,000 you took out, a lot of you are thinking, oh, that $8,000 came from your 10. It did not. Your $10,000 you put in just serves as collateral for that $8,000 loan. The $8,000 loan was the insurance company giving you part of that death benefit that we put on the policy early. And they charge interest on that. So let's just say they charge 4.25% to 5%. Does that really matter? No, because we just paid off a loan here for 5%. We paid off a loan here for 7%. We paid off loans, credit cards that were 20%. So we're making money. We're using a lower interest rate to pay off higher interest rate loans, but we're still earning interest on all of it. Did you miss that? Uninterrupted compound interest. We're still earning that. So now we got $5,500 coming back over here. So that's replenishing the money, which means every dollar you repay, $460 a month, is money you get to use immediately. Second year, you put $10,000 in again. The second year, we're going to have more than 80%. We might have like 85% because every year your money's earning compound interest, which means every year you have more money to use. But not only do you have more money to use here, so now we got $8,500 to use, we also have $5,520. So let's do the math. $8,500 plus the recaptured money, $5,520. So if we do the math, we got 20, we got 9, 10, 11, 12, 13. We got $14,020. Okay, so now the total amount in this segregated account that we have is $14,020. Not 85 because you got to add the two. So now let's go over here and figure out what can we pay off with $14,020. We can pay off the car. Okay, so now we're going to take and we're going to add $500 because the car loan's done. Now we paid, that was 10 grand, so we still have 4,000 here. So we're just going to pay 4,000 off here, and then that means we got 2,000 owed over here. So the only debt you have after the second year is about $2,000 to the credit cards. But now this isn't 200 anymore. Maybe now $2,000 might only be 50 bucks a month. So now we get to recapture. Well, I don't know, how much would that be? Another 50 bucks here. So let's do the math, because now we're saving more than 460. So let's erase these. Okay, folks, so we did the math. Since we paid the car off, we paid the cell phone off, we paid the remodel loan off, we paid the equipment, we paid the credit cards down to $2,000. This is only 2 years. We're now recapturing $1,010 a month, which is $12,120. You're recapturing more money than you're actually depositing. You see how you're building wealth here? And again, this is not new money. This is just money you were giving away. So now, in probably just a few months, not even, we can pay these credit cards off. So now you add $50 more here. So now we got $1,060 going back to your account. So now you got a whole bunch of money building up in your account. You're still saving the 10%, but you got all this extra money that you're saving every single month. So let's look at the next phase. Once all the debts are gone, because that was the easiest return you can get, risk-free. So now that all the debts are gone, what you've created here is your own banking system. Think about it. You've taken back the banking functions in your life. You no longer make monthly payments to their banks, you make monthly payments to your bank. You got $1,060 every single month coming back to your policy. That's specially designed and engineered whole life, that you're putting $10,000 in every single year, because that's 10% of the money you make. You are now banking. So after all the debts are gone, what are you going to do? Well, I don't know. A lot of people like real estate. Let's say you want to invest in real estate. So now we got all this excess money. So let's just make that money go to work and we can invest in real estate. So in 1 year, that's a little over 20 grand. So we can take that and do a down payment on a rental. And let's just say that rental nets $300 a month. So now you've got yourself an asset. That asset produces net rental income of $300. So now we add that over here. So now that $300 extra is added to the other amounts. You got $1,360 being recaptured back up here, filling your pot. And on we go. You could start lending money. Maybe you don't want to own real estate, so maybe you loan money out on this property. And maybe you loan money out at 12%. You can see everything that we do here just keeps adding to the pot. It's one giant circle. Money in, money out. Money in, money out. You put money in your banking system, you move it out to buy assets, invest, do all the different things, pay off debts, and then whatever money that creates, that money just comes back to your bank. Because once you're the bank, why would you ever put your money, the money your money's making, back in their bank? You wouldn't do that. See, folks, what I like to call this is investing in yourself. You could not only do this with assets, you could invest in business opportunities that you have. You could invest in your own business. You could invest in yourself. This is your banking system, folks. Make the most of it. I certainly have, and so have over 7,000 other clients of ours throughout this country. You see, when you invest in things, you solve big problems for other people. There's always a problem to solve, and first, your banking system solves that problem. So folks, this video just touched the surface. This is like the pimple on the elephant's butt. That's how much I just taught you. There's so much more to learn. So let's start with this video right here, how to generate passive income with no initial funds. I can't wait for you to start your banking system because it's time for you to take back control of your money, and it's time for you to be your own bank. Folks, I'll see you on the inside, and I'll see you on the next video. Thank you.